It's great to be with you all here today, and thank you for coming along. So I want to start with the team. I think one of the key things we look at when we invest in any company is the management. What's their track record, history? Do we believe that they're going to be able to achieve what or manage the company in the most in the best fashion? So if I look at the team managing this pool of capital in this portfolio, there are a couple of key characteristics. One, the depth of experience in investing in global equities. And the other is this is a team that has worked together over a long period of time investing in global equities. They've worked together in bullish markets, in challenging markets, in down markets, and I think that experience counts for a lot. So what does the portfolio, what does EGI look to provide its investors? It's a concentrated portfolio providing exposure to global equities with a focus on mid and small cap stocks, companies with a market cap of sub $10 billion. The background of most of the team members is very much family office. We've managed money for a number of family offices over a long period of time, and that leads to an absolute return focus. Protect capital and achieve strong risk-adjusted returns over a long period of time. We're contrarian. We want to find opportunities where the crowd isn't necessarily at already, but where we feel they are going to be. Mid-small cap bias, I'll come back to that and cover that in some detail in a moment. Risk-reward asymmetry. So what do I mean by that? We want to make sure that we're getting paid appropriately for the amount of risk that we are taking. So if we do all our work and assess that the downside risk is 10%, we don't want to just feel that there's 10% upside. We want to feel that there's 20 or 30 or 40% upside. We have to be paid for the risk that we're taking. And then a really critical part of investing and managing the portfolio is risk management. So what do I mean by that? And there are a number of triggers we use to achieve that. So sell discipline. Anyone can buy an equity, selling is much harder. So we make sure that when an investment reaches our price target, that we're conscious of it, we discuss it, and we make sure that if it should be sold, that it is sold. We don't sit there trying to convince ourselves that there's momentum and we're going to ignore our valuation around it. We also believe that if you get it wrong or the thesis changes, you have to be prepared to sell. And that's another critical part of the way we manage the portfolio. Cash buffer, we have an ability to be up to 50% cash. We don't look to manage for beta, but if there's a period where we're not finding the opportunities and we have slightly more cash, that's okay. And then at times we'll use derivatives, and when I use the word derivatives, I mean very vanilla, to protect the portfolio. So that might be some vanilla put options on the index that manage for market risk as opposed to stock-specific risk. Why is this portfolio different? So one of the key things we've found over many years of investing, one of the best areas to achieve returns is where there is change and where companies are going through a period of what we call price discovery. So what does that mean? That could be a spin-off, where a company is spinning, where a division of a company is spinning out of a larger entity. That could be management change. We all know that there are a lot of great businesses that have been suboptimally managed. You put in a new CEO, new CFO, changes at high level management can make a very material difference. Post-IPO. So you could have a company that lists during volatile market times, during a period where that industry is going through a tough period of time. There are a number of reasons why an IPO might not perform out of the gate. Fallen angels, where a company has fallen in value by 15% or more for the wrong reasons, not the right reasons, and that provides opportunities to investors. Corporate restructure, where typically this will happen when new management comes in, where they might sell off businesses or enhance the businesses that are already there. And then embedded optionality, where we feel the market is not ascribing value to an asset inside of the company, or where the company spent a whole lot of capex developing new products that are about to launch, and the market is not ascribing any value to them. So you're kind of getting a free option there. What's really interesting about all of these dynamics is often it will mean that the company goes through a period where investors are not sure how to value them. What is the underlying intrinsic value? Because as you go through change creates an element of uncertainty. But to investors, what that provides is also tremendous opportunity. So how do we capture that? We have a series of databases, proprietary databases, that automatically capture any companies that fit any of these price discovery filters. Every week, there is a fresh pool of opportunities that come across our desk, every week. We do a lot of work, and only a select few make it through to the portfolio. What's really interesting about those criteria is it leads to a mid-small cap bias, companies with a market cap of sub $10 billion. And what it also does is ensures that this portfolio is made up of companies that you are unlikely to find in most other global portfolios. So let me give you a bit of a snapshot of what I mean by mega or large cap universe and the mid-small cap universe globally. So this refers to the 23 developed markets that we look at. In the mega large cap universe, you've got over 1,100 companies. The Googles, the Facebooks, the Amazons that a lot of people have exposure to. You can get exposure to these companies through funds, a lot of funds, ETFs, directly, easy to buy. What's really interesting is that mid-small cap universe, sub $10 billion US, is more than 5 times the size. It has significantly less analyst coverage. So just to give you an idea, a Google might have 45 analysts covering it. A lot of these stocks might have 2 or 3. Again, that equals tremendous opportunity. So if you think about it, most domestic portfolios have exposure to large caps, mid caps, small caps, micro caps. The question that investors need to ask themselves is why should their global portfolios be any different? So I want to take you through a couple of examples that'll give you an insight into what we look for. So in today's world, one of the key things is disruption. It's amazing how many industries are being disrupted. Industries that none of us ever thought would be disrupted. And you do not want to be on the wrong side of that. So from our perspective, we say we want to be able to take advantage of that disruption. Buying the disruptors is hard. But there are a lot of companies, a lot of businesses, a lot of industries that are actually beneficiaries of disruption and have huge tailwinds. So let me give you an example. If you look at the way we consume media, historically it's been television, it's been DVD, films. That's been turned on its head in recent years. Video streaming, Netflix, Amazon, Hulu has completely disrupted that space. But one of the great beneficiaries of that disruption is content. The demand for content is surging. And the traditional providers of that content, the Disneys, the Viacoms and others, they are setting up their own streaming services. So the hunger from Amazon and Netflix to have their own exclusive content and original content is just growing. To give you an idea, those two companies this year will spend over $10 billion on buying content. Entertainment One is one of the largest independent content developers, producers and distributors in the world. It owns 2 of the top 3 preschool children's shows in the world today. Those shows, Peppa Pig, which I suspect a number of you have heard of, and that's shown on YouTube, and PJ Masks, which is shown on Disney, have been phenomenal successes. They generated $1.4 billion of merchandise revenue last year, and what's amazing is that Entertainment One clips the ticket every time. They get a licensed revenue stream, a royalty stream, so it's a phenomenally cash flow generative business. The next show to come out of this pipeline is a show called Ricky Zoom, and the tests have been phenomenal. So the pipeline is really deep here. Television. So they have a company with Mark Gordon, who's one of the most prolific producers in the US. He's responsible for one of the hottest shows globally last year, Designated Survivor. So Designated Survivor was shown on ABC in the US, and then Netflix licensed it outside of the US for the rest of the world. What I'm trying to show you here is they've been a huge beneficiary of these streaming services. So as disruptions come in, they've been a winner from that. And they're also in film and music, the same dynamics. This company has a market cap of £1.2 billion. The valuation metrics are very undemanding. There's tremendous momentum in their shows with a tremendous pipeline. Over $10 billion spent this year by just two companies, Amazon and Netflix, and this company has a £1.2 billion market cap. The next thematic that we are invested in is the shift from conventional to LED and connected LED lighting. What's quite incredible is that since 1880, when the first commercial LED lights were manufactured, there's been very little development in lighting technology. Until recently, about 10 years ago, LED lighting started to become commercially available. Philips Lighting spun out of the large Royal Dutch Philips company about a year ago. It is the leader globally in conventional and LED and connected LED lighting. So as conventional lighting declines, they've taken the strategy of being last man standing in that space, and that's harvested tremendous free cash flow. On the other side of that coin, they've also been growing dramatically in selling LED lights. And both of these businesses are just basically dumb lights that you screw into the light bulb, no connectivity. Those businesses are great, they generate strong free cash flow, but they're not the exciting part of the story. And the market is only valuing this company based on those two businesses, in our opinion. What's really exciting here is connected lighting. So let's think about that. What is connected lighting? It's a bulb with a chip in it. It enables those light bulbs to communicate, so you can control them from afar. They can be turned up and turned down whenever you want. Functionality. So first and foremost, what LED does is, through energy efficiency, reduces the cost by up to 80% of your lighting. What connected LED does is then overlays a huge amount of functionality into your lighting. It's a massive step up. So that's useful for infrastructure, for example. The City of Los Angeles recently changed 110,000 of their streetlights to connected LED lighting. Increases safety, increases functionality. The City of Jakarta did the same. Let's think about that for a minute. If you extrapolate that out across all the cities in the world, we're at a very early stage of what is a phenomenal opportunity. The same for office buildings. Just think of the wasted energy in office buildings. It's just huge. As those office buildings shift to connected lighting, that will change materially. The same for the home. Exactly the same level of functionality. If you look at Perth Stadium, Philips recently put in the first stadium full LED functioning facility globally. That could be rolled out across stadiums all over the world. So the runway and the opportunity in connected LED lighting is absolutely phenomenal at a very, very early stage. Again, what I want to show here is we're investing in a business that has a tremendous tailwind, that is a beneficiary of disruption. What I wanted to show is that our portfolio is benchmark independent. We're bottom-up stock pickers. If you look at the chart on the left, Hostelworld, which we've owned for a long while now, as we got to know the story, we build the position. Its performance is independent of the market. If you have a look here, it traded along for a while, and then eventually the intrinsic value of the company comes to bear with investors, and it has a re-rate. The same with PayPal. remember when we first bought PayPal, just before it spun out of eBay, everywhere we went, the noise. But what about Apple Pay? What about Visa? What about MasterCard? All we saw was opportunity. Phenomenal free cash flow, growing at 20% per annum in a space that had a tremendous runway ahead of it, tremendous opportunity. It took a while, but that growth just continued to accelerate. And at some point, investors have no choice but to step up and take notice. And what I want to point out is, in terms of investing stock specific and not benchmark dependent, only one of the 10 stocks in our top 10 holdings is in an index. So let me just give you an insight into the top 10. Equiniti. Equiniti is a UK listed company. It's a play on compliance. Compliance in the world today is growing at a phenomenal rate. Again, a tremendous tailwind for any investor. If you think of Computershare, similar businesses. So Equiniti has the number one position in share registry in the UK, 50% share. It's the number one in pension administration in the UK. It also provides software services that deal with KYC, that deal with complaints resolution management. Tremendous business, very entrenched market positions. When that company listed, there was a lot of noise around them potentially losing one or two of their clients in the share registry business. We kept looking at it and we couldn't understand why it was trading so cheaply. And that was the comment that kept coming up. But it was being priced for them to lose 5 or 6 clients, not 1 or 2. 8 times earnings, tremendous free cash flow. We started acquiring the position and gradually kept increasing. What has happened since then is a material re-rate of the stock, as investors have come to realise that not only are they not losing clients, they've actually been gaining clients. Zayo, again, a company with tremendous tailwind due to a technological trend. So fibre is to data what a road is to a car. You need it. And if you think when you go on a train and you look around and everyone's sitting on their phones, that's data usage, and it's just increasing. When we go from 4G to 5G, 5G is a very data-rich network. That data will need to come off the network as quickly as possible into a fibre network. Zayo is the only listed national fibre network in the US that's remaining. The industry's been consolidated dramatically. It's an unbelievable asset that has started as that network gets more dense and you're signing on more and more customers, the value of the network increases as the cash flow starts to ramp up. And that's the stage Zayo is at. Tremendous tailwinds again. And just to give you an idea, recent transactions in the space have been undertaken at a significant premium to Zayo's valuation. The Stars Group. Stars Group is the largest online gambling business in the world, a 70% share of online poker, 10 times larger than its biggest competitor. That's a very important point because poker is reliant on the pool, the size of the pool. Hard to compete with that. They've also launched online casino and had tremendous take-up. Online sportsbook, tremendous take-up. What's really interesting is the optionality underlying this business. In the US, for instance, there are only 3 states that allow online gambling. If you think of, in 2006, the US outlawed online gambling, and even if, when that comes back, it's only half the size, and even if these guys get only half of that, it'll more than double their business. The opportunity is huge. So the optionality is terrific, the tailwind is terrific, and the valuation is undemanding. Venator, recently spun out of Huntsman Chemical. Venator is the number 3 player in the world in a product called TiO2. I think the best way to describe it is anything that's white will typically have TiO2 in it. So if your white goods didn't have TiO2 in it, they'd be grey goods. So Venator is in a space that had a massive supply glut in 2011. Between then and now, that industry has consolidated significantly. There are 6 players that now control a majority of that production. In the meantime, the Chinese have also clamped down on pollution emissions, therefore making it harder for them to come and cause price discrepancies in this space. TiO2 price peaked at $4,000 in 2011, came down to $2,000 at its low, and has really started to creep up now, but is in the early stage of a recovery. All the stars seem to be aligned here, and again, this is trading at a discount to its peers. One of the key things about companies going through a period of price discovery, when this spun out, at first there's no coverage. Investors aren't familiar with the company, it's new to the boards. So over that period, it will often trade at a discount to its peers, again providing opportunity to investors. Interaction and QTS are again both plays on our view on data and the growth in data. Interaction is the only listed data centre business in Europe. 45 data centres, 2 of which, the one in Marseille and the one in Frankfurt, are 2 of the most prominent, important data centres in the whole of Europe. QTS has 23 data centres in the US. These businesses are, we call them our compounding companies. You can check in, but you can never leave. Once a company goes into one of these data centres, they tend to be there for life. There's not much turnover, and not only do they tend to be there for life, their demand for capacity keeps on growing. These are unbelievable businesses with a reasonably high barrier to entry because you need the pipes coming into the building. And then Hostelworld. So Hostelworld is the #1 online booking platform for hostels. The hostel industry has undergone tremendous transformation over recent years, where it's been corporatised, so it's not these grungy places that we all remember from years ago. A lot of these hostels are now like 3-star hotels. These guys are the #1 booking platform for those hostels. If you think how many people are doing gap years, how many kids are doing gap years these days, that demand has just been growing and growing. What's interesting here, I've asked a lot of kids that have just done gap years, who are you using when you travel through Europe and you look to book a hostel? And without fail, they all say Hostelworld. The power of the anecdote is very strong. And what's really interesting here? The cash flow. Tremendous balance sheet, net cash with net cash on the balance sheet, strong free cash flow, growing, and with the opportunity, as they move into the next phase of their development, to start connecting all the people staying in hostels. So you have this Facebook effect. The potential incremental value from that is phenomenal. So I want to turn to performance now. So since inception, EGI has provided investors with an annual return of over 11%, which is significantly ahead of the benchmark. And what I also want to show here is the volatility. I think it's a really important point to make. The volatility of the portfolio has been materially less than market volatility. And when you can see there, kind of in the middle of that chart, when the market had its really significant dips, the portfolio was far more resilient. This is a portfolio that's invested in stocks that have strong thematics behind them, but are underpinned by a value investing bias. The valuations are more value-based. Now I want to touch on the discount. So as you can see, the underlying performance has been very strong, and the share price performance has recently picked up quite dramatically. And I want to just take you through the 5 things that we are doing at the moment to ensure that that discount goes away. One is options. So on the 10th of April, the options fall due. We're working to make sure that's done in an optimised fashion, and we believe that once those options are out of the way and the structure is clear, that'll make a material difference to any discount. The dividend. So the dividend has been increased 50% over the past 12 months, and what we look to do is provide a long-term, sustainable, fully franked dividend. Promotion. We're out there telling investors what we do. There are a lot of funds out there that will give you global exposure at the big cap end. There aren't many that will give it at the mid and small cap end. And we're out there telling investors that that's what we do, and here's what we own, and here's why we own it. And we think that's making a difference. The rating Brian touched on before. We will be rated before the year is out. Why is that important? There are many planners that are not able to invest in a fund like this unless there is a rating in place, or they won't invest unless there is a rating in place. So it opens our potential investor base. And then going forward, what I think is the most important thing of all is ongoing good performance. So I thank you all for hearing me today, and I'd like to pass you over to Mary Manning. Thanks.